More optimism to kick off the session 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
AI front and center with AMD predicting accelerating sales growth driven by strong data center demand.
President Trump prepares to host a dinner with Wall Street executive heavyweights, including Jamie Dimon, David Solomon, and Larry Fink.
Plus, as the shutdown nears, economic warning signs emerge. More Americans are falling behind on car payments than ever before. Growing anxiety about jobs doesn't help.
Yeah, we'll have more about that story at the end of the hour. For now, Matt, though, the everything rallying but tech trend yesterday is reversing this morning. Some of the tech names doing well, AMD among them, up 6.2%. The CEO, Lisa Su, said that revenue growth will surge over the next 3 to 5 years. AI data center revenue, that alone will increase to an average of 80% each year. So one day it's, we're terrified about AI and its energy and capacity constraints. The next day it's, everything's wonderful.
Yeah, Anthropic going to spend $50 billion this next year on data centers. Roger Federer-backed sneaker brand On Holding raised its outlook as sales soar in Europe and Asia. The company is poised to surpass sales goals for the second year in a row. And as a result, the company gains another fifth in market cap, Dani.
Let's get back to that story on AMD with expected revenue growth of at least 35% over the next 3 years. Let's bring in Bloomberg Tech co-host Caroline Hyde on this. And Caroline, it is a vast different sentiment than we saw yesterday. How big are these numbers? 35%, 80%? I thought it was supposed to be like 200, 300. Is that a good figure?
It's a lot better than the market had been anticipating. Look, to give that sort of breadth from 3 to 5 years in full outlook, we are starting to see ultimately that this is better than the market had thought, maybe a 20% growth rate. So we're seeing 35% committed to until that sort of full range. We're also seeing a total addressable market of $1 trillion. I'm becoming numb to the trillion-dollar figures. But more broadly, we are seeing Lisa Su getting specific about the CPU offering that they can get into the AI data centers, but more broadly into GPU, real AI accelerator competition with NVIDIA. This is no longer an also-ran kind of a company. This is a company that can gain market share when it comes to AI data centers, continue to win when it comes to AI PCs, and really sort of eat Intel's lunch more broadly when it comes to the overall offering that we use with our everyday handheld devices.
So how concerning is the lack of energy for these data centers? I mean, I know AMD is going to sell the chips regardless, I guess, in the short term of whether we can get the power. But over the longer run, it's going to be a real problem.
Well, she faced some real questions about ultimately the question of AI bubble, whether or not there's a lot of circular financing, and she managed to breeze through that, just saying she doesn't want to bet against OpenAI, for example. She's also, though, still saying that government support is where it's necessary. She talked more about the fabrication of chips in the United States rather than perhaps what we've heard from CoreWeave yesterday. Michael and Trader came on the show saying, look, the US government can play a role here when it comes to getting infrastructure up and ready a little bit faster, when it comes to ultimately the sign-offs that you're going to get from a state and city perspective. But AMD is really going to have to say, they are there to provide with the scale of chips that are necessary. But look, we're all wondering how quickly these data centers can come online. And that's sort of the narrative that we've been fighting for the last week.
Well, then you have the earnings, the like of Akila, who said that they're getting more cash and cash equivalents, and that the government, they're focusing on Department of Energy build-outs too. How much is the government playing a role here in some of this?
Well, DOE is actually a real fosterer of driving force for AMD because, in particular, that is where the MI AI accelerator demand is coming from. It's from the Energy Department. It's also from what they've signed up with the likes of OpenAI. They've already been signing it with Oracle. And you've got to remember, these are players that have been alongside President Trump. At the very beginning of his administration, we saw Sam Altman alongside Larry Ellison talking about the AI infrastructure build-out. The government has an eye on this. Department of Energy has an eye on this. And this is where Lisa Su is trying to say AMD can offer you the power efficiency that's necessary going forward. We've got the innovation in place, and we're going to be able to get you on our MI accelerator bandwidth going forward that will ultimately drive that innovation that's necessary so we don't have to have quite so much power. But ultimately, that is going to be where some of the holdouts are at the moment.
All right, Caroline, thanks very much. Bloomberg text Caroline Hyde there talking about the AMD news that's really driving these markets. Now, strategists at Goldman Sachs expect U.S. equities to continue lagging global peers for the next decade. Peter Oppenheimer and his team recommend that investors increase diversification beyond the U.S. And you can see from this chart, the white line being the U.S. valuation, just starting to soar away from the rest of world valuation in blue, the delta there in purple, so you can see that growth. Peter Oppenheimer and his team see the S&P returning an average of 6.5% over the next 10 years, but everyone else, especially emerging markets, doing even better. Bloomberg macro strategist Michael Ball joins us. So is this the end of that trend that we see from the chart?
Yeah, that's what they're thinking. And it's not just on the valuations, which obviously have been talked about a lot in the last couple of weeks, as we're all worried about the concentration in leadership and how far the AI trade has gone. But also they see structural reform and they see better nominal GDP growth. And with that, it's not just better growth because of inflation also going up, but more contained inflation, creating a better backdrop for financial conditions to loosen and allow equities to kind of outperform. And this is obviously going to be different between every EM. They're all their own unique butterflies. But overall, if you lump them together, there are structural reforms in place, and there's a better growth dynamic that should boost earnings and margins on the kind of, margins will also be better defended, I suppose. They're not expected to necessarily blow out, but they're not expected to contract on pressures from idiosyncratic stories.
But people love to make this prediction. It usually doesn't come true. Last year when people said it, it did. This year we have seen those markets outperform. Right. Who's to say that that's really going to last? Because if you were to have traded on valuations in the past decade, you probably would have missed out on a lot of American equity gains.
Right. I think it's a little bit, you have to be careful. Like, obviously, there's ways for investors to buy the basket of EM. But overall, like I said, there's going to be these individual stories. There's going to be outperformances. They also did highlight basically Asia, ex-China, and Japan is looking pretty strong. But you are going to have to pick your countries. You are going to have to be very clear on what your target is, because there are always these shocks, and they come out of nowhere often. And to your point, we get these good narratives going, and then something unforeseen comes and knocks everything off.
Right. The way I read it, it's not just about valuations, right? It's also the idea that, at least in terms of the emerging markets call, which I think he said is going to see 10% average annual growth, the idea is that AI is going to provide more productivity to those economies than it will to our more developed economies.
Yeah, and super interesting, because we were just talking about that whole power part. If EM starts to look at sort of the open source algorithmic advancements that the Chinese AIs are pushing, that's less power, it's less infrastructure potentially for data warehousing. Now, I'm not an expert on this, and we can bring others on to speak to it.
Power hungry is what
but exactly, and this is always a constraint. Now, as the demographics grow in some of these countries, there's going to be more of a jostle for who gets that power. Whereas in America and the West, some of that's already set with our demographics being more stable.
And by the way, we're going to have the CEO of SambaNova on, too, who presumably, or they say, builds a chip and a GPU that uses less energy. So it'll be interesting to get his take. Michael, thank you so much. Bloomberg's Michael Ball. Elsewhere in D.C., House lawmakers are set to vote on a measure to end the 43-day government shutdown. It will reinstate fired workers, guarantees back pay for furloughed employees, and prevents further layoffs through the end of January. Here's House Democrat leader Hakeem Jeffries.
House Republicans, welcome back from your taxpayer-funded 7-week vacation. You now have an opportunity to actually take some action in an area of this healthcare crisis by working with Democrats before the Rules Committee this evening to extend the Affordable Care Act tax credits.
Bloomberg senior editor Mike Shepard joins us now. Mike, day 43 and the last day of the government shutdown?
It's looking to be that way. The House is on track to vote sometime this evening. We're expecting it to take place about 7 p.m., and the president is expected to sign the measure as soon as it hits his desk. We don't know if that'll be tonight or first thing tomorrow morning, but they're looking to move quickly to end this. Now, Dani, one thing that's important to note is that even with the shutdown ending, there will be some lingering effects. The disruption that we have seen, for instance, with air travel, that will go on for a couple of more days, and it could take even longer to restore some of the food aid and other government services that were disrupted along with air travel as a result of the shutdown. And Dani, another thing that we're going to see linger through all of this is you just heard from House Democratic leader Hakeem Jeffries is recrimination within his own party. There is a lot of frustration among Democrats with the decision by 8 Democratic moderates in the Senate to side with Republicans to pass this spending measure without gaining the key concession that they wanted. And that was namely the extension of those subsidies under the Affordable Care Act that are set to expire at the end of this year. Democrats are now looking at a couple of options. One, some have talked about ousting Senate Democratic leader Chuck Schumer. Others have also said, look, we have to take this now to the midterm elections and wage our health care fight then.
By the way, there's been a lot of talk about the power that companies like BlackRock and Vanguard yield because they vote on proxies for their clients, essentially. Also, Glass Lewis and these kind of shareholder activist groups. President Trump is going to have, I guess, lunch or dinner with a number of Wall Street executives, including Jamie Dimon and Adena Friedman. What do you think we're going to hear from that?
Well, for now, Matt, it is a dinner. It's scheduled for 7:30 p.m. on the official White House calendar. And publicly, the White House is not saying who will be in attendance. But we have confirmed that some leading lights from Wall Street will be there, including Jamie Dimon. And we also know that David Solomon from Goldman Sachs and Larry Fink from BlackRock have been invited. Now, on the agenda, they will have a lot to talk about. Naturally, the shutdown and whatever concerns Wall Street may have surrounding federal spending will certainly be a topic of discussion, as it usually is. But the executives may also get into other areas that are sensitive, and that includes financial regulation, the proxy rules you just mentioned. They may also talk about the immigration crackdown, especially the higher fees on H-1B visas that many Wall Street firms use to add to their ranks in the U.S. They may also talk about what's happening with tariffs, the sweeping levies imposed on U.S. trading partners around the world, and what the economic fallout may be and how Wall Street is taking that on. And then, of course, there is the question of artificial intelligence and whether there may be too much punch in the bowl these days when it comes to spending on AI, and whether these executives have any concerns surrounding all of that and surrounding the returns. We've heard Jamie Dimon talk about how JPMorgan Chase is using AI. So this may be a topic that the president will want to talk about as well. Remember, he has grown very close to Silicon Valley, and he had a high-profile dinner in September that he actually brought the press in with a number of key tech leaders.
All right, Mike, thanks so much for joining us. Bloomberg's Mike Shepard there in Washington. Let's get a quick check on what's going on in the markets with futures rising. S&P 500 futures up 0.33%. NASDAQ futures up 0.6% as investors continue to be optimistic about the AI CapEx.
I was worried you were going to say, like, because the shutdown is ending. Like, are we still trading on that? There's no way, right?
I couldn't imagine that we are, but there are some stocks, right? Like
yes.
Cava.
And Sweetgreen.
Yes.
Citi basically said, watch out, they might outperform because they get a lot of their revenue from the D.C., Maryland, Virginia area. All right, some other movers.
Delmarva.
Delmarva?
Yeah. Delaware, Maryland, and Virginia.
Oh, well, I was thinking it was the DMV, which is where I'm from.
Okay.
D.C.,
okay.
Maryland, Virginia. All right, some other stocks moving on our radar. Nuclear energy company Akila is rising on a plan to launch a commercial plant and focus more on Energy Department authorization.
Oh, here we go. Let's take a look at Cava and Sweetgreen shares added to Citi's 90-day positive catalyst watch list, with analysts expecting sales to improve once the government shutdown ends.
And stablecoin giant Circle, they beat expectations on their earnings, but the return rate is concerning investors, and it controls 29% of the stablecoin market. Coming up, Intel reportedly has its eyes on a chip startup. SambaNova CEO Rodrigo Liang joins us next to share his outlook for AI and their company. You're watching Bloomberg TV.
Now to high interest, look at what's making headlines around the world. House Democrats released newly obtained emails from Jeffrey Epstein alleging that President Trump, quote, spent hours at his home with one of Epstein's victims and also, quote, knew about the girls. The messages sent years after Epstein's 2008 conviction were written to Ghislaine Maxwell and author Michael Wolff. Democrats say the emails raised new questions about Trump's ties to Epstein and accuse the White House of withholding the related files. The president denies all wrongdoing, calling the claims a political hoax. More Americans are missing car payments. Fitch says subprime delinquencies hit 6.65% in October. That's the highest since 1994. Inflation, student loan bills, and high rates are straining wallets, forcing some lenders into bankruptcy and leaving many drivers underwater on loans with interest, in some cases at 30% or more. Mercedes Formula One chief Toto Wolff is in talks to sell about 5% of his stake to CrowdStrike CEO George Kurtz in a deal that could value the entire team at $6 billion, a record for an F1 team. The deal isn't final, but would mark the highest ever F1 valuation, underscoring booming investor interest. Is it still fueled by Netflix's Drive to Survive?
Maybe not. Still, I don't know if it's as popular as it once was, but it certainly helped. I mean, they wouldn't be worth $6 billion if it weren't for Drive to Survive.
It just continues to climb, right? McLaren is worth $4 billion, now
Yes.
$6 billion for Mercedes. It's pretty incredible, and I think Drive to Survive has kind of worn off.
Yeah, I think you're right. I think it's just normal fans, Netflix or not. All right, turning back to the chip story this morning, Matt, as AMD predicted its annual revenue growth will average more than 35% over the next 3 to 5 years. Intel is said to be in early talks to acquire chip startup SambaNova. Joining us now for a Bloomberg exclusive is Rodrigo Liang, SambaNova co-founder and CEO. Rodrigo, thank you so much for joining us this morning. How are you thinking about this? Is SambaNova as a standalone company versus part of a big chip legacy brand?
Well, look, I think what's exciting about it is that we've been getting a lot of interest over the last few months around investing in the company. But look, every scenario we consider is about growing our footprint, accelerating our roadmap, driving our product into the market faster. AI inference is exploding, right? And as you just talked about with AMD, and we're seeing the same thing. We see quarter over quarter doubling of our business, multiple quarters in a row now. And so we're excited about that. And so we're just really excited about figuring out how to actually accelerate that into the market and growing faster.
I mean, your chips, reportedly the SN40L RDU chip, see how much I know about this, apparently use less power than competitors' products, right? And we've been hearing about Chinese AI using less power than American AI products. Can you give us the scoop there? I mean, how much of that is true and how much can that be improved?
Yeah, I think what you're seeing today is basically this interconnection between AI and scaling it and power and energy supply, right? And so the simple way to describe it is basically energy in and tokens out. That's really what you're thinking about and trying to figure out what is that conversion rate. And so there's actually a really interesting report that's coming out today from the Stanford Research Group that talks about SambaNova's technology, the SM40, being 4x more efficient than Blackwell's. And so if you think about this industry now, which I think McKinsey's estimating that the entirety of actually building out, scaling out this infrastructure, data centers and power and racks is 5 to 8 trillion. To meet the demands. Imagine what it would look like if we could deliver something that's 4x more efficient.
Now, is the SM40, though, used mainly for inference, whereas Blackwell's used for training, or does the SambaNova chip deliver both capabilities?
We do, but most of the time, what people are using SambaNova's SM40 is really for inferencing. As you know, inferencing is going to be 80–90% of the market going forward, right? And so we're really focused in on how do we deliver inferencing at a much lower power footprint, much lower cost. And this is really important because in the world of sovereign AI, every country is trying to figure out how to deploy their own data centers for AI models. Not everybody has gigawatt data centers available. And so being able to go with really energy efficient technology allows you to accelerate deploying these technology into the market.
We were talking about in the break how quickly these things are developing. Already, if you have a more efficient chip, presumably as the technology gets better, the efficiency only increases. What does it mean for this world that started all of these new energy products, that started reviving nuclear energy outputs, that's opening up places in Texas without leases being signed yet?
Yeah.
Is there a real risk we are going too far right now?
16 gigawatt campus in Texas.
Exactly. I mean, is that a real risk that, you know, in 5 years from now, these are going to be obsolete because of the efficiencies that are being delivered?
Well, I don't know if it's going to be obsolete. Look, in every scenario we model, energy requirement is going to be increasing over the next 5 years. This is an insatiable demand for AI. But that said, if you look at the race, all these different companies trying to get to scale of AI, energy is going to cap it. And so what you need to do is actually not just find supply of energy, but using the energy more efficiently. And this is where our technology, being 4x more efficient than the Blackwells, allows you to actually smooth out that curve. While energy is being delivered, how do I deliver more tokens to the market with the energy I have today?
I look at your company and see that Lip-Bu Tan is the chairman and, of course, also a CEO of Intel. And there's reports that Intel may be interested in just buying SambaNova. Would that work out, you think? Would that be a good strategy for them, for you?
Look, I think, if you think about kind of what the industry is looking for, NVIDIA is so dominant. NVIDIA is so dominant in the AI space. Their chips are, continue to be the most popular chip out there. And yet you have all these other players, whether that's an Intel, Qualcomm, AMD, all these different large players looking for solutions that compete. And companies like ours, SambaNova, where we've got a technology that's competing very well with NVIDIA, what we're looking for is scale. Right, what we're looking for is how to accelerate, how do we get capital, how do we drive that into the market faster. And so we're looking at various different options, including large investments into the company, including all these other partnerships that allow us to actually take that capital and translate our technology into something that competes against the largest company in the world.
So sometimes when you have dinner with Lip-Bu Tan, do you talk about selling the company to him?
Well, look, Lip-Bu is an incredible chairman since day one. And so, look, this company is on a track to be very, very competitive going forward. And so we do look at his leadership as the chairman in order to help us figure out kind of where to attack.
Rodrigo, thank you so much for joining us. You have to come back. We could do this all day. Rodrigo Liang of SambaNova, and you're watching Bloomberg TV.
Moments away from the start of trading, and optimism looks to drive a fresh rally on this Wednesday. Actually, we rallied into the end of yesterday's session, even with NVIDIA down 3%. That likely won't be the case today with NVIDIA because we got great news about chips. S&P futures up 0.3%. NASDAQ futures up 0.5%. Even the small caps are rallying. And by the way, we have two big CEOs ringing the bells. Down at the New York Stock Exchange, Ed Bastian celebrating 100 years of Delta, and the stock, I always run a comp function before I come over here, up 72% over the last 5 years, so better than a stick in the eye, not as good as being invested in the S&P. And the AMD CEO, Lisa Su, ringing the bell down at the NASDAQ. Obviously, her company is really driving markets today. I think Dani's just about to talk about the stock up another 7%, and it's already tripled over the last 5 years, so they've done very well.
They've done very well. Thank you for setting me up so wonderfully, Matt.
My pleasure.
I appreciate that.
Take it away.
So we do have AMD just here at the opening bell, up 7.5%. Lisa Su, who we were just seeing yesterday, said that revenue growth will surge over the next 3 to 5 years. She sees AI data center revenue alone increasing by an average 80% last year. She also said that the AI chip market will top $1 trillion by 2030. So how's that for some optimism? Shares rally, Matt.
Yeah, pushing us even higher. By the way, Roger Federer-backed sneaker brand, if you care about these things, or care about companies that gain 27% of their market cap in one day, raised its outlook as sales soar in Europe and Asia. The company poised to surpass sales goals for the second year in a row, and On, which is the ticker, is now a company worth $15 billion.
And Roger Federer is that much more wealthy.
Good for him.
Yeah.
He's earned it.
He's earned it. I don't really like his shoes, though. The On tennis shoes. Not that big of a fan.
I just don't really wear tennis shoes unless I'm playing tennis.
Right.
But I know a lot of the kids wear them all day long. JPMorgan's Meera Pandit says stocks might be expensive, but not too expensive. She argues that weaker tailwinds from policy and the consumer cycle, robust profits, growth exceptionalism, and structural factors justify these high valuations. Weaker economic tailwinds. Weaker economic tailwinds. Did we get that wrong, Meera?
No, you got that right.
Why does weaker economic tailwinds justify these valuations?
Well, essentially, we've been so resilient against not that much of a pressure coming from some of these cyclical benefits. Like, for example, if you compare to where we were during the aftermath of the pandemic, you had valuations almost as high as they are today, and you also had rates at zero, where we've had rates at 4% essentially or above, except for the last couple of weeks for 3 years. We are not coming out of a recession, so we don't have this cyclical boost from earnings, from the economic cycle, from valuations overall. We don't have this big fiscal impulse, not 25% of GDP plowed into the economy. And yet valuations are basically the same as they were a couple of years ago when we had all of this momentum pushing stocks higher. Now it's like the beach ball that you kind of can't keep down. You're trying to push down on these valuations, and yet all that pressure against them, and they're still continuing to rise because we see so much momentum behind profits. So people want to get what they're paying for, essentially. And you've seen 4 quarters in a row now of double-digit profit growth, a double-digit year last year, potentially a double-digit year this year, maybe even a double-digit profit growth year next year against typically mid to high single profit growth. So you have that incredible earnings, and even across the world, where it's no longer a TINA trade. You can buy bonds and get income. You can buy international stocks and get double-digit outperformance. If you look at the component of earnings that's driving the U.S. return relative to international returns, it's a lot higher in the U.S., so you still have that earnings exceptionalism. And then there are a number of structural factors. Entrance into the markets, whether it's passive flows, 401k, you have such a uptick in retail trading relative to prior to the pandemic, where that's a big pillar of the market as well. And all of those people are entering the market. And by the way, it's really hard to exit the market right now because of some of those embedded capital gains. So a lot of different factors here. Throw on one more, which is index composition, a growthier index relative to value of the 20 years ago.
Even with all that, though, you have seen international markets outperform the U.S. And Matt and I were talking about Goldman Sachs' Peter Oppenheimer, who said not only is that going to continue next year, it's going to continue for the next decade. And part of that is what we've all been talking about, is valuations are starting from a higher place. Do you think that, yes, U.S. has some room to outperform, but it's international, it's EM that outperforms the U.S.?
It's less about geography for me and more about AI. You have AI driving U.S. markets higher, whether it's within tech or industrials or utilities. But then you look abroad and you see Korea up almost 95% year to date. You have staggering double-digit returns in areas like Taiwan as well, China, of course, and particularly the areas of China that are linked to technology. So not so much the domestic A shares, which is a little bit less tech-heavy, but the H shares, Chinese ADRs, which are doing particularly well. So you're seeing that AI story permeate the world as we remind ourselves that many supply chains exist abroad, and the competing technologies that you're seeing coming out of China are pretty staggering, especially when you look at areas like robotics. So the EM trade, I certainly think that can continue, particularly in EM Asia, very much linked to that tech story that we're seeing here in the U.S.
We have a great chart on U.S. valuations versus MSCI World ex-U.S., right? And you can see that U.S. in white here, the rest of the world in blue. U.S. valuations have just pulled away over the last couple of decades, and the purple's just the delta there. Do you see this trend coming to an end now because of, I mean, Jensen Huang, for example, says China's going to win the AI race?
I think it's not just about who's innovating from a technology perspective, because certainly when we think about technology, they are doing some really advanced things overseas, again, particularly in areas like robotics. I think the question around AI is, do they choose to go the commoditization route and make it mass and scalable in a way that some of the advanced producers here in the U.S. are trying to continue to innovate in more advanced ways? Or do they really compete head on? But the other piece of this, when we think about it from an investor standpoint, is not just who's the best innovator, but who's the best capital allocator. And one of the things that U.S. companies have proved time and time again is that they know how to produce shareholder value by being smart capital allocators. I don't know that that exists everywhere in EM, which is why we're hyper selective about companies overseas.
What do you think of the Michael Burry argument then? Essentially that these companies are about to be hit by a huge depreciation cost because of their assets and all the capital expenditures they're doing. And if they don't show up in a real way with real meaningful AI revenue, it won't be enough to offset that, and then they'll have to pull back on CapEx pretty meaningfully.
I think there's a spectrum to that argument where even if you do see the useful life of some of these chips shorter than people anticipated, you're still seeing chips today that have a reasonably long useful life, even though there's more advanced options out there in the market. So not everything needs the absolute most advanced technology underpinning it. So I think that's an important thing to remember, that still the broader chip world is useful and reliable. I'd also say that it remains to be seen whether we see mass obsolescence when we think about the accounting factor here, or even just the innovation that maybe things even move beyond the table stakes of today. So it's definitely a valid criticism and one that we see as a key risk. But does that mean wholesale everything becomes obsolete and useless, or can we still continue to find uses for some of these things as we still scale up on some of the more advanced products as well?
Yeah, really thoughtful as always.
This is a great chart, by the way, that the macro man put together, showing CapEx. Now we're looking at $100 billion for S&P.
Which, by the way, OpenAI, I mean, that's just S&P. OpenAI itself has committed $1 trillion.
Right,
for that's over a long period.
$1.4 trillion over the foreseeable future,
right.
Although, when asked about it, Sam Altman said, like, sell your shares if you don't believe we can fund this. Because they only have $13 billion in revenue. Did you see that little back and forth?
It's wild.
The demand is there. I mean, you're still seeing that cloud growth, 27% growth year over year when you think about cloud revenues. So when you hear from the hyperscalers, when you hear from a lot of these AI companies, yes, some areas are really scaling up on revenues and not quite yet on profits, but that takes a little bit of time, and when you have an innovation and a technological revolution taking place, it does occur in phases. We're probably still in the early to mid phases of that whole transformation.
Meera, thank you so much for joining us this morning. Always great to have you on. JPMorgan Global Market Strategist Meera Pandit. All right, let's get a check on your equity market now, about 10 minutes into your trade. The Dow, by the way, has hit an all-time high. That's because financials are doing particularly well today. I'll show you that in a moment when we look at the sectors. But now here's the overall picture of this equity market. The breadth is pretty good. It's AMD that's the biggest contributor to the gains this morning. It's driving the S&P up by 3.5 points. Similar to NVIDIA, even though it's not even up 0.5%, but that's just because of how dominant the thing is. As I mentioned, some of these banks are doing well. JPMorgan's up. Jamie Dimon's going to be meeting with the president at the White House for a dinner. On the downside, it's also tech that's leading us down. Apple, Alphabet, Palantir, Meta, all in the top losers so far this morning. If you look at some of the sectors, again, financials are doing really well. Goldman Sachs is up, which means the Dow is up because it's a very differently composed index, so that's helping things out. That's followed by materials and healthcare. On the downside, energy is doing worse, down 0.6%, but it's actually the best performing sector over the past month. Not tech, but at least you're getting a rebound from the wider tech index, Matt.
All right, we are going to talk about all the Wall Street CEOs heading to the White House tonight when we come back. Will they vote in favor of stripping power from proxy voters like Glass Lewis and BlackRock? All the details for you when we come back. This is Open Interest.
Let's look at some of the top calls this morning, the analyst action that we are watching. First up, At&T, that gets an upgrade at KeyBank. The analysts there are calling the recent weakness overblown. They say the company's focus on integrating its wireless and home internet unit is pulling ahead of its peers. Those shares up 1.4%. Next up, Bath & Body Works, that gets cut to Raymond James thanks to what it says are near-term challenges. The analysts point out that digital and product improvements will take time. They also say recent innovations have underwhelmed. The stock is down 43% this year ahead of its earnings next week. They're up about 0.75% this year. And finally, Citi adding Cava and Sweetgreen to its 90-day positive catalyst watch list. They expect sales to bounce back as the government shutdown ends in the coming weeks. Both of the fast casual restaurants saw softness as federal paychecks were halted. So it's back to salad days, I guess. I believe Sweetgreen gets 11% of the revenue from the DMV, and for Cava, Matt, it's almost 20%.
Salad days.
I know.
I like that. Actually, I think that's a great Minor Threat record. If you ever listen to the DC punk rock band. Turning now to Wall Street, President Trump is set to host a big, beautiful dinner at the White House with bank CEOs, including JPMorgan CEO Jamie Dimon and others that you can see here. Joining us now is Jenny Serrain, Bloomberg Finance editor. And actually, Jenny, really cool to see Larry Fink there because it sets up maybe a little bit of a conflict, right? The president wants to take away, perhaps, some of the voting rights that a company like BlackRock has on behalf of its investors.
Yeah, I think it'll be really interesting because, you've got so many different dynamics that these guys could, use this opportunity to discuss with the president. Obviously, the ongoing debate over ending the shutdown, I think, will be one of many topics that they might try to discuss. How consumers are kind of faring and how they're seeing this play out in terms of, the loans that they make and the consumers that they serve might be another one. And then we have kind of the broader, regulatory rollback and the massive amount of deal making we're seeing, the kind of roaring capital markets. Trump might be wanting to pick their brains on what he could do to kind of keep all of that going, which I think would be music to a lot of these CEOs' ears. So there's lots of different ways that we could see this go. Obviously, with executives like this and a politician like this, it's hard to know exactly what will be discussed, but there's plenty of grist in the mill, if you will.
By the way, just having Larry Fink and Jamie Dimon in the room together will be interesting, considering Dimon once called those proxy groups a cancer, reportedly, so he is not a fan either. Jenny, how important...
That's what we're talking about. That's
right?
the drama.
Right? No, there could be some serious drama just between the men themselves. But Jenny, how important is it that these men and maybe one woman have a good relationship with President Trump? I mean, I don't see Brian Moynihan of Bank of America on this list, and it's a company that President Trump has railed against for debanking. How important is it for these executives to foster a relationship with the president?
I think it's a very delicate dance that a lot of these executives play kind of day in and day out. I think we've seen with this administration a willingness to kind of go after any number of companies, any number of industries. And so it's a very, sensitive time. And I think they all try to kind of avoid the limelight where they can while still taking this opportunity to kind of make their case and for, whatever the topic may be. So I think for a lot of these guys, just the general environment like we've been talking about, the capital markets coming back, the deal making finally seeing a way through, the regulatory rollback, those are probably all of the kind of lanes that they'll want to stay in because that's where they're already getting a lot of what they want, but they might see opportunities to push for even more.
Yeah, I mean, I wonder if they had a wish list, what would be on there? What can they get from the president, these Wall Street CEOs, or what is chief among their desires?
I think the big thing that they've all talked about is just this willingness to greenlight deals and be more open to M&A and merger activity. I think they've all really appreciated that. They like to see kind of the wheels of capital markets moving. The fact that the president has been so open to digital assets and kind of wanting the U.S. to be this hub for crypto activity. That's something that a lot of these banks are finally starting to experiment in. We just had the news yesterday that JPM is finally debuting its tokenized deposit JPM coin for its institutional clients. So you see a lot of these banks now, after years of experimenting, after years of trials and small focus groups, you really see them embracing a lot of these new areas. And a lot of that's just driven by the fact that they're getting the green light from their regulators to go out and play with some of this stuff. So I think you'll hear a lot of just keep doing what you're doing. And then, on the margins where the government shutdown might have impacted consumer spending or the health of consumers generally, there might be some discussion and back and forth about, how can we ensure that consumers are still staying afloat and the U.S. economy is still growing, because that's obviously things that are all supportive for these big banks' bottom lines.
I really can't wait for what I assume will be some good reporting to come out of this dinner, what's actually said. Jenny, thank you so much for joining us. Bloomberg's Jenny Serrain. Coming up, Eli Lilly drops CVS's drug benefit plan for its own employees. We explain what's costing workers. That's coming up next. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. Right now we see gains on the S&P, the NASDAQ falling, so a little bit of a divide here. And the reason is likely that we have NVIDIA shares down. This doesn't necessarily bode poorly for gains today on the S&P. Yesterday, the NVIDIA shares were down 3% and the S&P still closed with a gain, but it doesn't help, obviously, very heavily weighted. AMD, a big boost to the index right now, up 5.5%. On holding right now, up 25% after earnings and sales growth, especially overseas, that really boosted that brand. Circle, the stable coin out with earnings down 8%. Eli Lilly and Novo Nordisk still kind of locked in this battle. And we're going to talk about that in a second with regards to CVS. You know, CVS is no longer insuring and giving you Zepbound. Instead, they're going to try and move you to Wegovy. And Dani, we have more on the retaliation that Eli Lilly may be taking for that move.
That's right, because Eli Lilly now dropping CVS's health drug benefit plan for its employees. For more on that, we're joined by Bloomberg health reporter Madison Muller. Madison, it feels quite vindictive. And I guess my initial question was like, can they do this? But I guess they can because they are doing it.
Yeah, it's sort of the latest tick for tack in this ongoing war between Lilly and Novo that has involved CVS as well. And it is normal for employers to switch who they're using to manage their employees' drug benefit plans. Usually those contracts last around 3 years or so. But the timing is interesting given that CVS made this decision earlier this year in May to prefer Wegovy, which is Novo Nordisk's drug, over Eli Lilly's Zepbound, a rival weight loss drug. And so the timing is obviously interesting and makes sense if one of their biggest drugs sort of wasn't able to reach a lot of patients as a result of that decision.
Why did CVS drop coverage for patients using Zepbound? Because it's not the same drug as Wegovy, and so a lot of patients were actually benefiting from the use of Zepbound who don't deal well with the use of Wegovy.
Yeah, I mean, CVS actually openly says because of the competition and the popularity of these drugs, they were able to sort of, they said, do what PBMs do best and pit these two companies against each other to negotiate the best prices for their members. So they said that this decision has actually saved a lot of money for their members, which is an important piece of this because a lot of employers have said that costs are rising as a result of covering these drugs.
Many of their members have such adverse effects to the Novo drug that they can't take it, whereas with Zepbound, they were actually losing weight, reducing their risk of heart attack and diabetes.
Yeah, when you think about it from the patient perspective, this was really frustrating, really hard for a lot of patients. We did a story on this earlier this year. I talked to a lot of patients who were seeing really great success on Zepbound and sort of had their whole weight loss journey, medical care upended by this decision. And so even
if PBMs do best.
Yeah, exactly. I mean, that's what CVS said.
But isn't the total addressable market for these medications so huge? Why does it feel like every corner it is so vicious, be it these two companies or Pfizer, the battle over Metsera? It feels particularly intense even when the pie is gigantic for this medication.
Right, but it's right now two companies. I mean, Pfizer is still a few years away from reaching this market, and so for Novo and Lilly, like they are really competing. For so long they were neck and neck, and like Lilly was coming a bit from behind. I mean, Novo had their drugs on the market first, and so Lilly had to be pretty aggressive to catch up, but they also had a drug, Zepbound, which is more effective than Wegovy, and so they had that advantage. Now Novo is trying to sort of claw back market share in a market that they really lost out on to Lilly, and so the competition is just increasing, and then add in all these other drug makers that are trying to get in on it, and it just is sort of never ending.
All right, it's a pretty exciting space, Madison. Madison Muller covers weight loss drugs and pharmacy for us at Bloomberg News. Coming up in the next hour, Katrina Dudley will join us and talk about the increasingly K-shaped economy and earnings expectations versus consumer sentiment. Plus, Apollo's Akila Grewal joins us on the rise of credit, which was the strongest earnings driver for alternative asset managers last quarter. And Ducati's North America CEO Jason Chinnock talks about dirt bikes driving growth. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. The NASDAQ turning negative. Another day where big tech is under pressure, Matt.
Yeah, and coming up, we're going to talk about that. A&I remains front and center, with AMD predicting accelerating sales growth driven by strong data center demand.
And President Trump prepares to host a dinner with Wall Street heavyweights. That includes Jamie Dimon, David Solomon, and Larry Fink.
And Adina Friedman.
Also,
economic warning signs emerge as more Americans fall behind on car payments and grow anxious about their jobs.
And we begin with some breaking news this hour. Anthropic has announced plans to spend $50 billion on data centers in the U.S. Let's get the details with Bloomberg Tech co-host Ed Ludlow. And just looking at this headline, I'm kind of like, they didn't already promise that? It feels like every tech company has some huge number that they're going to be spending on data centers. What's Anthropic committing to?
Yeah, $50 billion in partnership with a British company called FluidStack, where they are owning and building and operating the data center facilities. But $50 billion is at much smaller scale than, say, compared to OpenAI. OpenAI, Anthropic's nearest rival as a frontier AI lab and commercial entity, has pledged $500 billion for the Stargate project alone in the United States, which it had plans to also take overseas. Meta is another good example, a different type of company, but within it an AI lab where their own domestic data center spending will be $600 billion. And for all three of those, it's stacked over a number of years. Where Anthropic's perhaps different is that this is $50 billion for something it's doing itself, but it has relied much more heavily on the hyperscale partners that it has, Amazon AWS, and as we reported most recently, Google, for use of Google's TPUs.
Do they have the revenue to fund this? I mean, this is a question that Sam Altman was posed recently because he wants to spend $1.4 trillion, but only has $13 billion in revenue. He didn't want to answer that question.
Right.
What about Anthropic?
So what we know from recent reports is that Anthropic is looking at revenues of about 70 billion, 70, by the calendar or fiscal year 2028. Right now, OpenAI, I think you mentioned the $13 billion figure. Its annual revenue run rate figure is about $20 billion for 2025. One point of interesting difference between the two of them, in part because Anthropic has not committed as much capital of its own up front, it's relied on this capital-light model with partners, is that there is a growing consensus that Anthropic may reach profitability quicker than OpenAI does, because OpenAI is committed to spending its way to growth in a way that Anthropic isn't, at that scale.
All right, Ed, looking forward to your coverage on Bloomberg Tech. Ed Ludlow co-hosts that program with Caroline Hyde. They join us back again at 11 a.m. Now, more breaking news, this time on the Fed. Atlanta Fed President Raphael Bostic is planning to retire from the U.S. Central Bank when his term ends on February 28th. Let's go now to Bloomberg's international economics and policy correspondent, Michael McKee. So, Mike, what do we know about what this does in terms of leaving openings for President Trump to put in place?
It really doesn't affect President Trump at all because the Atlanta Fed Board of Directors, made up of business leaders and bankers in the Atlanta region, will choose the next president. They're setting up a search committee. So the president doesn't get a chance to nominate somebody new. But it does leave an opening, and it does raise a question about whether that person will be more hawkish or dovish. Bostic, who's 59, has been on the Fed since 2017, and he's been a more hawkish voice recently. He was holding out for just one rate cut this year, and he thinks that with inflation where it is, the Fed should not be cutting too much at this point. So the fact that he's leaving will affect probably the way the committee looks at things next year. Now, Bostic was the first gay and first African-American member of the Federal Reserve Open Market Committee. So he has those distinctions. He also has the unfortunate distinction of being one of the Fed Bank presidents caught up in a trading scandal when in 2017 to 2023, I think he was, his financial advisors did some trading during Fed blackout periods, which violates Fed rules. The Fed's Inspector General cleared Bostic of doing anything illegal, but it was not a good look. And I bring that up now because to get back to what you were first asking about, the Fed itself, the Fed Board of Governors, votes on whether or not to renew the contracts of all of the Fed Bank presidents every 5 years. And that deadline is coming up February 28th. So we don't know if this is related to that. or not, but the timing is exactly the same.
All right, Mike, thank you very much. Bloomberg's Michael McKee there reporting on the latest news from Raphael Bostic. All right, let's get back to AI spending, where estimated net CapEx has hit $100 billion in the third quarter for the first time ever. This fantastic chart that comes from Macroman, just showing the huge amount of spending that's coming from it. Joining us now is Katrina Dudley, Franklin Templeton Public Market Senior Investment Strategist. And Katrina, it's fueled so much of the market, but it comes back to the point that Michael Burry made earlier in the week, that you're going to start getting some of these assets depreciating. And unless revenue shows up in a big way, you can't continue to fund the CapEx. Is that a real concern, that this is a driver of the market and as the economy could start to slow?
But what are we looking at funding CapEx? You're talking about depreciation as an expense, and that expense coming onto P&Ls. But what's offsetting it is the fact that we're getting cost savings. If you take a look at some of the cost savings that people are getting in terms of 30% reduction in costs from deploying a basic AI solution into your general counsel's office, for example, so you have a less need. So what I'm saying is that you can actually weather some of these increased depreciation charges that everyone is talking about with some of these cost savings.
Is the AI trade still investable, or is it too crowded? If you already own these assets, what are you going to buy?
I think that the AI trade is very early. We look at a lot of companies, they've gone from experiments to piloting solutions, but they still need to go to deployment. And this deployment is where you really see the kind of cost savings, you see the productivity benefits, and that's where you kind of have, you jump out that S-curve. So I think that we're so early in that stage. It's encouraging to me that companies are really now looking at moving those POCs into production, and that's really going to be a driver of this economy.
And meanwhile, here in the other parts of the economy, the federal government is set to reopen again. And with that, we're going to get a deluge of data before the next Fed decision. Not only will we get the October jobs report, but we have to get the September one to make up with that. September retail sales, third quarter GDP. This time around, are the data releases going to make more volatility in this market because we've kind of been in this fog? Does it matter less because we've already decided the alternate data is showing us something? What difference does it make this time around?
I think it will either cross-check and kind of confirm the alternative data, which therefore says that we actually have multiple ways of coming to the same conclusion, and that gives us a better robustness to the market and to the data that the market is relying on. And data is the key here, but you also need to think about it in terms of the Fed. The Fed is increasingly data dependent. They've been talking about that. And as we look at going, we had the rate cut in October. Everyone's watching December, and that's going to be
And no
key.
data.
I think you'll have December. You'll have data before December. You've got, as
How
you
data
said,
dependent can you be if you're missing 2 months of jobs and 1 month of
so first of all, you're exactly right. Like the Fed, the expectations are around 70%. People are expecting the Fed to cut again. It's in December. We are not in that camp. If we look at the inflation numbers, inflation is not even close to being at the Fed's 2% target. And I think that they still need to get inflation under control. That's the first part. And then secondly, if we look at the employment numbers, employment is actually below what we've seen as the full employment. Full employment is around a 5% unemployment number. We've been persistently below that. And so we've got a good economy. And then finally, if we look at the GDP growth number, and I know that some of these are just estimates, but that GDP number continues to be positive. The economy is growing and it is still strong, which leads us to believe that we may not see a cut in December.
We're getting to that time of year where everyone makes their predictions for 2026. It felt like last year, especially after the election of Donald Trump, there was so much conviction. It was America's going to outperform. That didn't play out. Or it would be volatility because of tariffs coming in. There was that, but again, we recovered from it. How much conviction can you have in 2026, especially with the recency bias of how different this year played out?
So if you look at the beginning of this year, you're right. We had DeepSeek. Then we had the situation, and we're looking at in what happened to the U.S. dollar as well. You had Germany. They were like the final economy that was holding to having a positive budget and going into deficit. And then finally, as you said, you had Liberation Day and those tariffs. As we look into next year, what have we got? We've got strong GDP growth. If I look at estimates, earning estimates are for double digits. And I will say it again, I've said it here before, earnings are what drives markets. And so if we continue to have faith in that double-digit earnings estimate, and finally, if we have a look, AI is going to be a driver. At the moment, it's driving on the CapEx side. We think that AI is going to be the driver on the productivity side. So we're actually very optimistic about that.
I'm just curious what you think of the Dow Jones Industrial Average. It's a point of contention, not just on this show, but I think generationally. And it is kind of silly to be price weighted. I get that. But these companies are, if I look down the list, all set to either benefit from AI, Goldman Sachs, American Express, even, I guess, to some extent, McDonald's, or to make it, right? Caterpillar right at the top of the list, Microsoft. I mean, what do you think of I just bring it up because we have another record high on the Dow, but.
Look, 6 out of 11 companies, sectors generated double-digit earnings growth just in this last quarter. So that is the part that we've been missing, which is the breadth of the market. And I think the Dow Jones, despite the price weighting versus, market cap weighting, the fact is it is probably one of the most representative indexes in terms of it touches all parts of the economy. You've just given us the example. It touches the consumer with McDonald's. It touches heavy equipment with Caterpillar and construction there. It also touches on financial services. So I think that, in terms of AI, all of those companies, you're right, will in some degree benefit from AI. And secondly, all of those companies are benefiting from the breadth of the market that we continue to expect to drive this market forward in 2026.
I would love you to say this to John Farrow and see what he says.
Okay.
Next time.
I mean, it has underperformed. It's only up 13% year to date. And the Euro Stoxx 50, especially if you bought it in dollars, is crushing it up 32, 33%. So, Katrina, great having you on set with us. Thanks so much for joining us. Katrina Dudley there of Franklin Templeton. Let's get a check right now on what's going on in the markets. As I mentioned, the Dow Jones is up 0.8%. We have a new record there. But if you don't care, which a lot of people don't, you'll see that we have not equally strong gains on the S&P, only about 0.2% as NVIDIA drags us down to some extent. The NASDAQ unchanged here, and the 10-year yield, remember it wasn't trading yesterday, back up and running at 4.0751%.
Yeah, maybe some of those drops catching up to the negative ADP numbers that were out yesterday. Also some breaking news to recap from the top of this hour. Maybe this is helping tech at least not be negative this morning. Anthropic announcing plans to spend $50 billion to build data centers in several U.S. locations. That includes Texas and New York.
We also got news on the Fed. Atlanta Fed President Raphael Bostic is planning to retire from the U.S. Central Bank when his term ends at the end of February. And I mean, I'm not sure how much it affects the news, but I was sent by a trader a function on the Bloomberg. FDSP is a great way to look at the Fed in terms of hawks and doves.
Yeah, and I think Bostic's more on that hawk side, right, of that spectrum.
Yeah,
there.
absolutely, absolutely. So he has, he's a non-voter.
Right.
And he has a neutral rating, but that puts him, I guess, on the hawkish side.
Coming up on the show, credit fuels returns for alternative asset managers. We're going to discuss with Akila Grewal of Apollo Global Management. That's coming up next. You're watching Bloomberg.
Let's get to high interest now. Look what's making headlines around the world. Morgan Stanley Investment Management and Global Student Accommodation are buying a $1 billion portfolio of U.S. student housing from Abu Dhabi's wealth fund and Landmark Properties. The deal adds 8 sites with 6,200 beds near major schools like Penn State and UVA, expanding Morgan Stanley's fast-growing college housing push. The fitness band maker Whoop is weighing an IPO within 2 years as it expands into glucose monitoring and new health tools. The CEO says FDA talks on its blood pressure feature are constructive. Subscriptions are up 75% in 2 years, and it plans blood tests for hormonal and metabolic health by 2026. The company is training its own AI model that may be able to predict heart attacks and strokes. And Vista Equity Partners is said to be planning major job cuts as it leans into AI. The private equity firm told investors it expects to shrink its workforce by as much as a third over the coming years. According to the Financial Times, the CEO said AI tools will replace or streamline roles across operations, investor relations, and back office functions, allowing Vista to expand without hiring new staff. Dani?
Yeah, and Vista's Robert Smith has always been very vocal about AI's potential for replacing jobs. Let's stay with private markets, but turning to credit. Data compiled by Bloomberg shows that credit strategies drove most of the fundraising for the biggest publicly traded alternative asset managers in the third quarter. Joining us now is Akila Grewal, partner and global head of product at Apollo Global Management. Wonderful to see you this morning. Thank you so much for joining.
Thank you for having me.
And of course, like Apollo is the firm that everybody wants to be in terms of growing your credit product. But it's true. The growth has been insane, coming from a period where it was already insane. I mean, does this thing slow down? Are we in a world where like private credit's kind of eating everything?
I think you're asking the right question, which is credit has grown tremendously, and our view is that it's going to continue to grow. Our view is that private credit is an enduring asset category, and we've expanded the definition of what that means. We focus not just on kind of direct lending. Of course, we have a big franchise that does that, but I think our leg up has really been the fact that we have an insurance balance sheet that has allowed us to originate private assets and private credit across the risk-return spectrum, right? Everything from investment grade, lower returning, through to higher returning opportunities for our third-party investors. And having a broad aperture in terms of what does private credit really mean, I think is something that we will continue to see going forward.
We had Cliff asking this on a couple of days ago, and he raises questions about the marks, right? The opacity of this asset. I saw a story that BlackRock had been marking Renovo Home Partners debt at 100 cents on the dollar, weeks before it went bankrupt. Even though BlackRock knew they were restructuring like earlier this year, how can investors rely on that kind of asset?
I think it's a great question, and I think the reality is we have to continue to raise the bar in terms of transparency on these situations. At the end of the day, there's been a lot of commentary on a number of the names, like the ones you mentioned, in terms of what does that really mean for private credit and private markets. Our view is with any asset class that's growing so tremendously, there are likely to be accidents, right? It comes down to fundamental risk-taking and understanding the structure behind in what you're investing. And I think from our perspective, making sure that there's transparency and that you're talking to your investors frequently, as well as getting, third-party marks and ensuring that you're having that two-way dialogue with your investors.
Right, and I'm pretty sure Paul had like a teeny tiny little exposure to the one Matt's talking about. Again, nowhere near the size of BlackRock, but with these, again, you grow, there are more accidents, it happens. Has it changed at all due diligence? Like, is there more due diligence happening? Have watch name lists increased? Has it changed anything on that front?
I think absolutely. I think the reality is as this asset classes continue to grow, underwriting standards just have to continue to be maintained, and you have to avoid the exuberance to deploy capital, right? It's about being prudent, being okay missing things, and making sure that you're aligned, which we are, with what we're investing in with our third parties. So from our perspective, it's definitely raising the bar and making sure you maintain that bar and not get succumbed by having to deploy capital for the sake of deploying capital.
Wait, didn't you just interview John Gray?
Yes.
And he was saying, as the Fed cuts,
returns will be lower.
Yes, and how do you guard against that sort of reduction in yield? Do you go longer duration? Do you just aim for more scale? Do you take on SRTs? What do you do?
I think for us, we would focus on longer duration assets, which honestly is very much akin to a lot of the way that our investors invest, which is they have longer maturities in terms of what they're looking for, so making sure that asset liability is matched. I think it's about making sure you can create structural alpha, right, and ensuring that you're still getting the protections that you need. And to your point, it's about making sure that you are not necessarily chasing yield. We would rather not go lower in quality to get that outsized return, but we'd rather be very intellectually honest about where rates and yields are, while still creating structural alpha, working with in companies with scale, and then also trying to make sure we have the right duration.
Really, not too long ago, you launched a sports platform. It feels like a lot of people are launching sports platforms, but you have your first big deal this week, buying Atletico Madrid, the first big football investment. Matt wants me to say soccer, I'll say football. How much of this, when you think about it, because the ticket sizes for some of these are smaller than the huge AI deals you're doing, for example. So how do you think about the potential of this platform, and what is one, kind of good marketing for the company, because it is, these deals are really cool and a lot of people are excited about them, versus something that's really scalable and gives juicy returns?
Right. I think that, so we launched Apollo Sports Capital in September of this past fall, and we were really excited about it. Our approach has been to really focus on long duration kind of strategy for the sports ecosystem holistically. If you think about sports today, the way that typically people have invested in it, it's been in the equity ecosystem. It's been almost an over-equitized asset class from our perspective. And so we're approaching it from a hybrid, debt-oriented, structured equity perspective. And we think that will open up a really broad array of opportunities. Sports, in our mind, is growing, right? You're getting more and more demand for it. When you think about AI, it's a little bit insulated, not fully, but a little bit insulated from those trends, and it tends to be uncorrelated. So from our perspective, if you broaden the definition of sports, right, it's not just teams, it's not just leagues, it's also stadium financings, it's also player transfer rights, it's also media-related rights. You can actually have a pretty broad addressable market, which can deliver scale. We're very excited about Atletico Madrid, the football team, and I think that it's going to hopefully be a really marquee investment for us, right? We believe that it is a top team in the Spanish league, and we're going to work with our management team there to make sure that we add value where we haven't historically.
It's so interesting as you get into a world, as you get into like deglobalization, you really see borders fall when it comes to appreciation for sports. There's no longer a controversy about soccer versus football. Right. There's a huge inventory of companies that you could buy here. So
I see what you're doing.
What's next?
I think that we don't have any sort of specific, we need to be in football or we need to be in baseball or F1 or NFL or NBA. We think that it's a really broad-based opportunity set, and so long as we're getting the right valuations, we're structuring things that make sense for the ultimate capital structure, we're very open.
Padel, probably.
Padel, yeah. Yes.
Over pickleball, right?
Right. Oh, please,
yes.
Over pickleball. We started this conversation with kind of like Apollo being the envy and people trying to replicate some of the strategies you've had. That's also happening, but in a different part of this market, in hedge funds. Millennium and Point72 are launching private capital strategies. Point72 is specifically doing credit. That's failed in the past, having these hedge funds do private capital. What does it say about where we are in the cycle and the potential risks to get more tourists, as it were, participating in private capital?
I think private markets are generally growing, right? And if you look at earnings, if you look at revenue, if you look at employment, it is mostly a private market as compared to a public one. So it doesn't surprise me that many other investors are starting to dip their toes, so to speak, in the private markets. It just comes down to experience, knowing how to structure, where to lean in. And so, we'll see how that evolves. But it doesn't surprise me that, additional market players are investing in private markets.
I wonder just a little bit about the regulatory response, and not now during this term, but eventually, to this kind of growth, especially as it's funded by insurers. You were pioneers in that sense, but everybody else seems to be following suit. Do you worry a little bit about a crackdown in other administrations?
We don't really worry about that too much because at the end of the day, a large part, the majority of our balance sheet right now is a regulated entity via our insurance balance sheet. We are fully transparent on pricing. We are fully transparent on our positions. We have to adhere to various regulations. And so for us, we're not necessarily worried about that, but it is something that is very top of mind for many people.
All right, well, it's great having you in. I hope we can have you back soon. Akila Grewal there of Apollo Global Management, absolutely crushing it, as evidenced by that chart at the top of the segment. It's like Apollo's just literally off the chart. Let's get a check on what's going on in the markets right now. A little bit of a mixed trade here as the NASDAQ falls and the S&P is treading water. You've got AMD shares adding optimism to this market while NVIDIA drops. You can see AMD up more than 10% now, but NVIDIA has been a weight on all the major indexes on which it's listed. Coming up, sales at Ducati have been rising as the motorcycle industry and the rest of the country slump. So what are they doing right, and how can they accelerate those gains? We'll talk to the North American CEO, Jason Chinnock, next. This is Open Interest. From the track to the trail, Ducati is firing up its first motocross bikes and heading off-road. North American CEO Jason Chinnock joins us here in studio as Ducati defies an industry slowdown and bets on dirt to drive its next leg of growth. I hope that is suitable. I made that up. But perfect. I mean, is that the case? Because, you've always been this road bike, master, and Ducati has won, I don't know how many now, MotoGP, Constructor, and rider titles, plus Superbike, World Superbike. now you're getting into off-road. Is that really going to be driving the next leg of growth?
That's exactly our expectation, and especially for the U.S. market. I mean, if we think about this, the U.S. market's going to be at least 50% of that global business for us. And the thing that it allows is not only do we now go into, let's say, some markets that might not have been large enough to be viable for Ducati, like, say, some rural markets where off-road is a really big part of the motorcycling culture, but it also opens up that entire rider base to a whole new world of Ducati. And what's been impressive, I've been at supercross races and motocross races all over the year, just sitting there talking to people, talking to the owners, the riders. And what they say is, well, you know, we don't know a lot about Ducati, but what we do know is if you're bringing that expertise of what you do in MotoGP to the dirt, we're all in. They're like super excited about it.
I have to say, so obviously I've been riding Ducatis for 20 years. I've known Jason for that long, and I've been a MotoGP fan. Ducati absolutely dominates. Like a fair amount of times they've been 1, 2, and 3 on the podium. Now they have the greatest, maybe the greatest MotoGP rider of all time, winning the World Championship this year, Marc Marquez. And you've entered dirt at a really opportune time because KTM is like, who knows how long they stay solvent, right? And they have been pretty dominant in off-road. And then you have grown up doing this, even as you're working for Lamborghini and you're working for Ducati and you serve the U.S. military. By the way, thank you for your service a day after Veterans Day. You've always been in the dirt. So you have an incredible advantage here.
Yeah, I think that the thing is not only from an emotional perspective, as a motorcyclist, am I connected to that, but I read this amazing article a couple years ago that was the way to the heart of American motorcyclists is not what you think. And most people's very first experience with motorcycling in the U.S. is riding off-road. So it's a way for us to connect with that. And quite honestly, in a lot of my free time, that's what I'm doing. I'm actually riding in the dirt, riding trails. I'm not a supercross, motocross guy.
You're a mountain biker.
I'm a mountain bike as well. So, but I mix. I love that, and it allows me to have the same sort of freedom and escape that I get when I'm riding on the street as well. A lot less traffic. So it's something that has really been a personal joy to me. So I feel like I'm learning a lot still, but I have a little bit of an advantage because I have already an emotional connection to what we're doing.
By the way, speaking of emotional connections, milestones, next year, the 100th year anniversary, you kind of tease new products. What kind of things might we expect?
Well, I love this. I mean, the centenario, you know, only comes once for a brand. And for me to be able part of this, we were saying it's a century made up in seconds. And it's kind of a little nod to racing. But we have a really robust plan for this next year, not only in terms of all of the activities and events and things that we're going to do to celebrate this moment, but of course, we're going to have a lot of special products. You know, we're having products that will be coming out that will recognize that history of what we've done with Ducati and some milestones of racing, milestones of design, and things that will come out over the course of the next year. It's a little premature for me to give it away yet, but it's enough to know that there's some, I think, things that people will identify as moments of Ducati's history that they can reconnect with, which is the perfect time to do it.
We're looking at video of the new Hyper Motard, which is an all-new bike that you just revealed. I used to go to the world premiere for Ducati in Milan, which was always at the beginning of November. One time you released all the new bikes. Now you're doing it staggered throughout the year, right? Has that helped? I mean, what has allowed Ducati to continue selling more bikes in the U.S. as other manufacturers sell fewer?
So first off, does it help? I think so, because if you launch everything at once, you sometimes just run the risk of one product standing out over the other and getting drowned out. So we have taken a little bit of this different approach where we stagger it through, but we also have 12 new products coming out in the next 12 months. I mean, it's like the largest product portfolio ever. So you need every product to be able to breathe. And product does drive people into the dealerships, and that's a big part of it. But another part is the shift that we've had in our brand, how we positioned ourselves into being more of an upper premium brand, really focusing on lifestyle, on experiences, and on giving people a reason not only to own the bike. It's not about owning it, it's what do you do with it? What sort of experiences are you going to have? Are you going to go on rides and adventures with your friends? Are you going to spend time at the track and hone your skills? Or soon, are you going to go out and ride in the woods and enjoy riding off-road? So this kind of excitement that we maintain, and we live it. You know our global CEO, Claudio, we live it from the top all the way through the organization. We ride, we connect, we engage with our clients. Oh yeah, a lot faster than me. Maybe not off-road, we'll see.
A lot of people, though, would say this is like a very precarious time to be launching new products. For one, you have people feeling the bite of prices that have been high for some time and potentially even higher. How are you managing your supply chain and prices in additional tariffs that are impacting you?
There's no question it's been difficult. But there's also opportunity when that happens. And what I see is when some people are, let's say, pumping the brakes a little bit, and we saw this at the Milan Motorcycle Show last week. We looked at all of the new products that we would usually expect to come out. We didn't see them, but we're still with a full court press bringing everything out because people still want.
Are you charging more for them, though, to try to offset the margin?
Inevitably. I mean, we're going to have to. There's costs that have increased. We were surprised on a monthly basis of something new that's going to come or change, which is fine. We're learning to adapt to that. And we've been really clever about some things that we've done in finding savings elsewhere to try and minimize that passing on that cost. So it's actually helped us be better at doing business as well, which, whenever there's a crisis or whenever there's a problem, sometimes you just have to sit down and say, okay, clean sheet of paper, what do we do? And we've done that. And I just got done presenting our budget for next year. And it wasn't easy. It was the toughest one I've ever had to go through. But we've also found really clever ways to be smart about our spend and making sure we're getting returns on that so that we can keep investing into the products without extreme price increases as well.
Could you ever assemble a bike in the U.S.? I mean, I guess a super bike has to be built in Borgo Panigale, right? But I could imagine a dirt bike built in Detroit.
We've actually thrown around a lot of ideas, and that's been one that's been put on the table. At this point, we've decided against it for now because we feel like the investments we've made into our manufacturing, we need to get the return out of that as well. But could it be? For sure. I think that if we see ourselves in a situation where the North American market continues to grow, maybe there's opportunities to be able to bring some production here. Yet, it's honestly just a concept.
Dude, what is happening with Pecco this season? I mean, he's so inconsistent and often comes in close to the back of the pack, and you have Alex who continues to come in right up at the front. So, and other Ducati riders on non-factory bikes who are losing out, or beating, I should say, to Pecco, what's...
I have my own theories, but quite honestly, I couldn't comment because I'm confused by everything else that I read. It's the worst gossip next to Supercross and motocross racing, I'm learning, but MotoGP gossip in Europe, it's like, I don't know what to believe. Everything that I read, oh, is it the bike, isn't the bike, and then,
Can't be the bike, DG does great on it, and...
Exactly, where is his head? Or, I love the guy. I want to see him succeed. And there's a perfect opportunity for him to do it right now. Why he's not doing it, honestly, I can't tell you. But, when we have somebody like Marquez that came in and basically did almost a complete sweep through the season and locked down the championship early, it's clear that we have an incredible motorcycle, and both of them are great riders. So hopefully we'll see something shake out later before the end of the season into next year. So
we'll turn Dani into a fan.
Yeah.
She's in F1.
I like F1, so I feel like maybe it's a natural. I did one time watch a MotoGP because you told me to, and I was just scared for their lives the whole time.
They pass each other.
No,
it's
I don't
so
like it. It's really scary. I don't like it. Maybe I'll give it another go. Jason, thank you so much for joining us this morning. Wonderful to see you, Jason Chinnock of Ducati. All right, a check on markets this morning, and we've turned negative across all of the major indices this morning. Not the Dow Jones, though. That's still trading at a record. But you're looking at a decline of 0.33% for the NASDAQ. The S&P just ever so slightly lower, while yields continue to drop, but that's yesterday's trade because they were closed on Veterans Day. Yields lower by nearly 5 basis points at 406.74. Matt.
Let's take a look at some of the single stocks moving at this hour. AMD we've been talking about for the past couple, and they will be talking about for the next hour as well. Forecasting accelerating sales growth over the next 5 years, driven by strong demand for data center products, and as a result, the company adds 10% in market cap.
Meanwhile, nuclear energy company Akila, they've announced plans to launch a commercial plant in Idaho and focus more on energy department ties, though shares up more than 5%.
And Cava, as well as Sweetgreen, both added to Citi's 90-day positive catalyst watch list, with analysts expecting sales to improve once the government shutdown ends and people come back to work in Washington, D.C.
A reopening trade. I haven't heard that one in a while. Okay, coming up next, speaking of which, we head to Washington as House lawmakers are set to vote to end the 43-day government shutdown. We'll have your update on D.C. That's coming up next.
Nice, dude.
House Republicans, welcome back from your taxpayer-funded 7-week vacation. You now have an opportunity to actually take some action in an area of this healthcare crisis by working with Democrats before the Rules Committee this evening to extend the Affordable Care Act tax credits.
House lawmakers are returning to Washington today for the first time in nearly 8 weeks. They're set to vote on a measure to end the 43-day government shutdown. The legislation has already gotten the approval of President Trump. Bloomberg Washington correspondent Tyler Kendall joins us now from Washington, D.C. Tyler, is this day 43 and the last day of the government shutdown?
Hey, Dani. Well, it definitely looks like it. We are expecting this package to go to the full floor of the House later tonight. We're tracking around 8 p.m. Eastern for final passage, though. That, of course, could shift. But the understanding is it's going to go immediately to President Trump's desk for signature. Now, you heard the House Democratic leader Hakeem Jeffries there. He mentioned the Rules Committee last night. We did see Democrats attempt a last-ditch effort to add an amendment that would extend those Affordable Care Act premium tax subsidies, but it failed, which means that these lawmakers are voting on the legislation as it stands. This is a stopgap measure to fund the government through January 30th and some other key agencies through the rest of the fiscal year. Of course, if we've learned anything from covering the House of Representatives, there could always be snags. But we heard from House Speaker Mike Johnson earlier today, who said he is optimistic about how the vote is shaping up. He can only afford to lose 2 Republicans, and he also needs a quorum. 219 Republicans have to be in town for this to happen. And we know there's been flight delays across the country. But as of now, it looks like we are tracking that this is going to pass.
Tyler, we know that, the president has been averse to releasing the Epstein files, and his attorney general, Pam Bondi, even though she said she had them on her desk at one point, then said there were no Epstein files. Now it looks like a House panel is releasing an additional 20,000 Epstein documents, and the New York Times has a story that alleges Jeffrey Epstein himself said the president knew of the abuse and spent hours with the victim. Are these files coming out regardless of the pushback from the administration?
Well, so why this is all coming to a head now is because we are seeing the 218th Democratic member, Representative-elect Grewal from Arizona, being sworn in. There's been a delay to her swearing in, according to House leadership, because of the government shutdown. But that's important because it takes 218 votes to pursue what's known as a discharge petition, which will then force a vote on releasing the Epstein files. So perhaps we will see that come to a head later on today. We've seen some of these files come out, according to the ranking member on the House Oversight Committee, as you mentioned, and the New York Times has been reporting. So this is something that is going to start to creep up again as the government reopens. And the administration so far had been focused on issues elsewhere as they're trying to pull back from this issue that doesn't appear to be going away.
Elsewhere, the administration really seems to try to be fighting, or at least is facing this narrative of affordability, Tyler. Scott Bessent going on Fox News, the Secretary of Treasury, saying that they're going to be handing out those $2,000 checks to people making less than $100,000. And it also comes as President Trump is set to meet with a lot of Wall Street executives. How is that conversation taking shape, and how could the dinner change that?
Right. You've really hit on the overarching Washington theme of this meeting that we're expecting to happen tonight, which is that we've seen polls, including our own, conducted by the Harris poll for Bloomberg News, show that the majority of Americans are concerned right now about the state of the economy. And Republicans just saw a slew of losses last Tuesday when it came to this emphasis on affordability. This meeting is interesting tonight. We're showing on the screen there Jamie Dimon, David Solomon, Larry Fink, these big executives that we know that the administration has been courting. But of course, there's been a push and pull when it comes to tariff policy and tax policy at the same time. Also interesting that it comes on the heels of the Wall Street Journal reporting last night that we could see an executive order out of the administration that would curb the influence of proxy advisors, something that we know Jamie Dimon himself has raised. And we know that the JPMorgan Chase CEO has also pledged $1.5 trillion in investments in critical industries that the Trump administration wants to see investment in, including when it comes to semiconductors, chips, things that have to do with economic resilience. So it's probably going to be a broad-ranging conversation. At this point, the administration only has it listed as a private dinner at 7:30 p.m. Eastern.
A big, beautiful dinner. You think they'll talk about the 50-year mortgage, Tyler?
We'll see if that comes up. We know, of course, that has faced pushback from some in President Trump's own base. We've been asking economists about it all week, really, on balance of power. I'll say I have my eye on whether or not anything about any potential initial public offerings for Freddie Mac and Fannie Mae come up. We know that the big banks have already been courting the administration when it comes to this, so there's a slew of issues that they could really hit tonight.
Looking forward to the coverage. Tyler, thanks so much for joining us. Bloomberg's Tyler Kendall out of Washington, D.C. Coming up, cracks are forming in the underbelly of the U.S. economy as auto loan delinquencies pile up. We'll take a look at the data next. This is Bloomberg. More Americans than ever are falling behind on car payments. A new report from Fitch finding subprime delinquencies hit 6.65% in October. That's the highest since 1994. For more, we're joined by Stuart Paul, Bloomberg economics, U.S. economist. And I've read this is more than ever, and I've also read that it's the most since 1994. And those two things cannot be both true.
It looks like the most since 1994, and it is a high number of households that are defaulting and that are delinquent on their car payments. What's interesting, though, to me is that this comes on the heels of exuberance in the auto market that we saw post-COVID. Car payments are through the roof. Vehicle replacement costs are through the roof. Insurance costs are through the roof. And when that's the case, it shouldn't be that surprising that folks are becoming a little bit more willing to walk away from their vehicles. And I think that that's something that's going on right now when we look specifically at autos. You look at the rest of the data, we still see household bankruptcies running at a pace about 20% lower than they were pre-COVID. You still see banks increasingly willing to lend, including on vehicles and on credit cards to households. So while I think that the auto story is interesting, it might be more isolated within vehicles than it is an indicator of cracks, let's say, in credit, and an indicator for the rest of the business.
By the way, can I just interject that, so it is the highest share of subprime borrowers, at least 60 days late, ever, but records only go back to 1994. So it's possible that before that, even more. But the other thing that I think is crazy is that 28% of people who traded in their cars were underwater. 28%. And with car prices at an all-time high, you're losing money on the car you're trading in, and you're paying so much more for the new one that you're picking up. Like, it's insane.
Sure, car prices are at an all-time high, but think about the pace of a vehicle, I don't want to say appreciation, but the pace at which vehicle prices were rising during COVID. When you then have that stock of vehicles in the nationwide fleet, it's not that crazy to see that degree of depreciation within the fleet itself, even if prices for new vehicles continues rising.
Like with all these things, people look at the headlines and say it's the K-shaped getting worse. I wonder if when we're thinking about economic narratives, we're suffering from a little bit of confirmation bias. That yes, it is a K-shaped economy, but to your point, I mean, this is just the auto sector. It's not necessarily more widespread. And there does feel like there has been some pushback of like, is it as K-shaped as people are describing it as? How do you see it? Do you look at this headline and say, oh, it's just another example? Or I don't know, it's very isolated at this moment.
I'm hesitant to try to force the data to fit a narrative around a K-shaped economy. There's always this problem of income inequality or the distribution of wealth. You're always going to have people experiencing different aspects of the economy in different ways. But when you look at some of the economic aggregates and you look at credit conditions, again, household bankruptcy is still relatively low. Credit card companies are reporting that charge-off rates are falling. If you look at whether households are insulated from the effects of monetary policy because they termed out their debt during COVID, yes, they did. If you look at the upper end of the income distribution, credit spreads are narrow, home prices are flat to appreciating slowly, and mortgage rates are coming down, which should fuel those real asset prices even further. I'm really struggling to find the K-shaped narrative within the credit cycle, at least.
By the way, Joe in the control room makes a great point that repairs are also crazy expensive. Yep. You know, you can get a wing mirror knocked off, and that can run you $4 or $5 grand. And that means that insurance is incredibly high as well, adding to the already high payments. Scott Bessent, I heard on another network the other day, boasting about the fact that the big, beautiful bill had done away with interest on auto loans. but it hasn't, right? Only if you make less than $100,000 a year and you buy a new car and that car is made in the U.S., so most of these people, probably subprime borrowers, are buying used cars. And if not, then they're buying one made in Korea, right? We have a person in the story who is paying 32% interest. And it would be great if she could write that off, but she cannot.
Right. It's exceptionally difficult to write that off. When we think about what was included in the big, beautiful bill, it was more of a policy change intended to support domestic auto manufacturers than it was intended to support
only for lower income people buying new cars. Yeah.
Lower income people buying new cars from American auto manufacturers. But the point is, if it's only from American auto manufacturers and the policy itself was intended to support American manufacturers rather than intended to support broad-based affordability of monthly payments on things like vehicles. And I think that that's part of the story here, is that you still have this broad-based affordability issue, particularly in vehicles. That's a consequence in part of the exuberance that we saw post-COVID. And as the auto fleet ages, people are going to be more willing to walk away from their vehicles as replacement costs rise.
Stuart, this has been excellent. Thank you so much for joining us. Stuart Paul of Bloomberg Economics. Coming up on the show tomorrow, Seema Shah, Principal Asset Management, and Cameron Dossett of New Edge Wealth, plus Hoya Capital Real Estate CIO.